Happy Monday, everybody. I hope you had a great weekend. Welcome to what promises to be a wild week. We'll get into that in just a moment. Today is November 4th, 2024, and this is your Monday election week market update. As we do this time every week, let's review what happened last week and let's preview this week and what a week it's going to be. Last week on Monday, markets were fueled by a busy earnings week and anticipation of key economic data and the upcoming U.S. election. We did see almost all areas of the market finish in the green. Energy was the only one to close lower on the day. Oil was back down below $68 a barrel. Israel's retaliation was not as bad as feared, and that let people grab onto the easing geopolitical tension narrative. Well, since I was just there, I'm not so sure that I agree with that, but that is what the markets are telling us. So something we're watching closely. Bond yields also continued rising during the week due to weak demand in treasury auctions and investor concerns about inflation. The 10-year yield reached 4.30%, climbing 20% over the past month, reflecting expectations of inflation popping back up. We did see an unexpected election outcome in Japan that at least set up for political gridlock there, and the Bank of Japan staying quiet for the time being. News flows were pretty quiet, and markets did lose some steam, but they still finished higher. At the end of the day, the Dow was up over 0.75%, the S&P was up about 0.25%, and the Nasdaq was up 0.33%. The week got started again watching for a big week. Earnings from Magnificent Seven members: Apple, Amazon, Meta, Microsoft, and Google, as well as inflation information on Thursday and Friday, and of course jobs. Tuesday, we kept that going. We saw mixed performances among the major indices amid elevated levels of volatility, fluctuating bond yields, and earnings releases that stirred investor sentiment. So driving the markets were bond yields again, highest level since July on the 10-year yield. It did come back down after the JOLTS data showed a significant drop in job openings, hinting at potential labor market softening. This brought yields down slightly, supporting equities later in the day. The earnings parade did go into full action as Alphabet reported a notable 35% year-over-year increase in cloud revenue, which propelled its stock 1.5% higher at the close. On the other hand, AMD posted lower than expected forward guidance, leading to an 8.5% drop of that stock. The JOLTS report showed a drop in the U.S. job openings to 7.44 million, the lowest level we've seen since January 2021, suggesting, as I said, a cooling labor market. Consumer confidence is strong, up more than 11% in October, reaching its highest level of the year, positive indicator for market sentiment, despite the mixed signals in the labor data. For the day, the Dow was down 0.33%, S&P up less than 0.25%, and the Nasdaq was up 0.75%. On Wednesday, U.S. stock market bounced around and was mixed as it reacted to earnings results and eco data releases. Big news in the tech space, not one we've heard in a while. EY dropped SMCI, the chip company, as an audit client as they were not happy with the books. That rattled markets a bit. For anyone that's been around a while, no one likes to hear this. Chips were crushed. Guilt by association, the SOX index was down over 3.5%. Strong Q3 GDP report helped things a bit. Consumer spending was still strong enough. October ADP jobs report showed a strong number, and home sales were even up much higher than expected. Markets opened lower and then all over the place, pushed by the news, and then a 4.30 on the 10-year yield again. By the end of the day, the Dow was down 0.25%, S&P 500 down 1/3%, and the Nasdaq was down just a bit over 0.5%. On Thursday, the U.S. stock market had to deal with disappointing tech earnings and eco data that signal persistent inflation, not helping the idea of imminent rate cuts by the Federal Reserve. Microsoft and Meta platforms led the decline among tech giants, with Microsoft shares falling 6% and Meta dropping over 4% due to weaker than expected earnings reports. Other companies jumped in too, not just the tech side. In a market that is priced for perfection, the reports did not have to be bad to cause selling. They just had not to be as stellar. And some of them took some of the wind out of the sails of the markets. Thursday eco data did come in slightly hot, further weakening sentiment. Core PCI price index, the one that the Fed prefers, came in at 2.7% year over year, just above the expected 2.6, signaling sticky inflation that could stop the Fed from their rapid rate cuts. Jobless claims added to the drama. Initial jobless claims fell to a multi-month low, pointing to a tight labor market. These reports add up to concerns that inflationary pressures remain stubborn. The 10-year yield, which had initially spiked above 4.3%, saw a temporary pullback, but continued to contribute to selling pressure across the broad market. This environment has created a headwind for equities, especially for high valuation stocks in the tech sector, which are particularly sensitive to rising rates. Again, if markets are priced for perfection, anything less than that will not do. By the end of the day, the Dow was down just under 1%, S&P down almost 2%, the Nasdaq was down 2.75%. On Friday, markets opened higher as they reacted to the anticipated jobs report. not too hot would be an understatement. It was expected that the Boeing strike and the hurricane could contribute to some noisy numbers, but only 12,000 new jobs versus 100,000 expected. So labor is losing steam, and that leads markets to price back in the Fed's aggressive cuts. Amazon and Intel, both Dow stocks, were both up, lending to about 100 points of pressure on the positive side on the Dow in the open. Chips were back up on Friday as well, shaking off the blues from a tough news week from earlier in the week. For those keeping score, government jobs did account for second largest job growth, and for that GDP number, government spending was up almost 10%, driven by defense and state and local. So prolonged growth in those areas, not always so good, right? So for the day, the Dow was up 2/3%, S&P up about 0.5%, the NASDAQ was up 0.75%. For the week, the Dow was down 0.25%, S&P and NASDAQ both down about 1.5% each. October, the month everyone seemed to worry about, Dow was down 1.33%, S&P was down 1%, the NASDAQ was down 0.5%. Just for a sense of comparison, the S&P has had the best return in the first 10 months of an election year since 1936. We're up almost 20%. The average election year return going back to 1952 is about 1%, according to LPL Research. Well, if last week was not enough, this week is going to make that look like a sleeper. So in case you think anything else will matter, we'll get factory orders, services PMI, initial and continuing jobless claims. We'll end the week with the University of Michigan sentiment and inflation expectation numbers. But if you hear 30 seconds on that, I'll be surprised. Of course, the election is Tuesday, and if that was not enough, we'll get the Fed meeting on Wednesday and Thursday and the statement and press conference on Thursday. I've discussed the lack of clarity of Fed speak over the years, all the way back to Greenspan, who seemed to do that on purpose. But I hope I'm wrong, but we'll get a lot of ambiguous news over the coming days about the election, and maybe even, who knows, who holds Congress and the presidency? Maybe. I think that the Fed report is actually going to be the most clear of the bunch. So we'll also get some earnings, and you'll know that how I feel that earnings are what drives stock prices over the long term, but they will be ignored to a large degree just in the short term. Too much other noise out there. There really is not much else to say about the coming week. I'll leave this elections edition with some election year statistics. Split government, White House one party, Congress the other. This is what most people see as gridlock. I've been using the line I saw on a bumper sticker once. The opposite of pro is con, and the opposite of progress, Congress. So is gridlock really good? According to Bespoke, since 1901, one party in control, the Dow had an annualized gain of 7.5%. If it's a split government, 4.5% annualized return. Also from Bespoke since 1901, Dow's median performance during Democratic presidents has been almost 31% compared to 22.5% for Republican presidents. But if you annualize that, the average performance for Dems is 7.7% and Republicans 7.9%. Pretty close. Regardless, this is one that I'll leave you with, especially if you have an ounce of fear. Since Eisenhower was inaugurated in 1953, $1,000 invested in the S&P only during Republican administrations would be now $29,000 by March of this year. Total return. If only during Democratic administrations you put your money into the S&P 500, $58,800. But if you were invested the whole time, it'd be worth $1.7 million. So as I keep telling you, it depends on your risk tolerance and your time horizon, but the math shows that staying the course is the key. Not trying to be in or out based on the party in power. Please know your goals, know what we need to do to make them, and let's keep our heads about us and stick to the plan. We may get some volatility soon, and in most cases, that is also known as opportunity. So please stay close as we have a lot to do, and we get close to the end of the year. There'll be so much commentary on this. I will not do a special report video on this for you, but watch for Friday's video. I will start off with some quick updates before I dig into some planning ideas as usual. For now, please exercise your civic duty and vote. Let's stay in touch, and let's stay grounded and focused. Have a great week.